The Trump tariffs are rocking the global markets in a historic series of events. And as a real estate investor, you need to know how this impacts you. Let me ask you something. When the economy's shaky, when the markets are all over the place, when the headlines are full of uncertainty, what do smart investors do? They don't panic. They don't sit on the sidelines. They double down on what works. And that's exactly what I'm doing in 2025. I'm doubling down on investing in real estate, specifically rental properties. Not because I'm ignoring the news, but because I've been here before. I know how this story goes. When everyone else is unsure, uncertain, or standing still, that's when opportunity opens up. And this year, we are looking at a massive one. Here's what's happening right now. On April 2nd, the Trump administration announced a sweeping trade policy built around something called reciprocal tariffs. It began with a 10% baseline tariffs on imports from all countries. But that wasn't all. Countries the US has large trade deficits with, including China, Vietnam, Taiwan, and others, were hit with much higher tariffs. This was meant to close the gap and level the playing field with our largest competitors. The White House said the goal was to reshore American manufacturing, protect US workers, and address what it calls an unfair global trade system. Last year alone, the US trade deficit in goods hit $1.2 trillion, and the new policies aim to shrink that number. Now, I'm not here to take a side politically. I'm here to look at the data and, more importantly, the opportunity it creates. Because the market response, it was immediate. The S&P 500 tanked, dropping 688 points in just a few days. And globally, over $5 trillion vanished from the markets in less than 48 hours. Investors clearly got spooked. Economists started raising their recession alarms, and suddenly the mood on Wall Street turned real gloomy real fast. Goldman Sachs raised the odds of a US recession from 35% to 45%. JP Morgan's estimate jumped from 40% to 60%, citing fears of inflation and retaliation from other countries. Morgan Stanley said a recession is now a very realistic scenario. Markets were bracing for the worst. But then on April 9th, a surprising move. The Trump administration announced a 90-day pause on the most aggressive parts of the tariff plan. This pause looks like a way to give US trade partners a chance to come to the table if they're willing to negotiate and not fire back with their own tariffs. And just the hint of a pause was enough to help markets rebound from the dip. But make no mistake, we're not in the clear. The 10% baseline tariffs are still in effect. And for China, which is a major global trade engine, tariffs of 145% are already in place. And not surprisingly, China has retaliated with tariffs from 84% to 125% on imports from the US. According to Treasury Secretary Scott Bessent, the original tariff package represented the ceiling, the worst-case scenario for markets and inflation. But now, even with this pause, the remaining baseline tariffs are the new floor. And that floor still poses a threat. It's keeping inflation pressures alive. It's keeping the Fed on edge. And it's why traders expect 3 rate cuts in 2025, roughly 75 basis points over the whole year. Although there's no guarantee they'll do it this time around, the Fed typically responds to recessions by lowering borrowing costs in order to stimulate the economy. So what's the bottom line? Uncertainty is here, and it seems like volatility is the new norm. Even real estate will feel it. There's no doubt about it. Take the commercial sector, especially industrial real estate. It's already feeling the heat. Why? Most goods stored in warehouses, especially near coastal ports, are imported. So when tariffs rise, even by 10%, storage costs jump. That squeezes demand, disrupts supply chains, and makes last-mile distribution less efficient. Keep in mind that these shipping and logistics networks exploded during the online shopping boom. These are the locations that warehouse goods locally and allow companies like Amazon to ship goods to your home overnight and even same day. As a result of this boom, investors had been pouring into industrial real estate as it's been one of the best performing sectors of commercial real estate. Now, the momentum has flipped entirely. What was booming is now slowing down and has a questionable future. With inflation risks and a global slowdown in the mix, the sector's under serious strain, particularly for those making long-term bets like developers and tenants. Even a lot of the big players in commercial real estate are pumping the brakes. But wait, didn't I say I'm doubling down on real estate this year? I still am, just in the right corner of the real estate market. That's why I'm focused on single-family homes and small multifamily properties. Unlike commercial real estate, they're not getting hit the same way. Owning residential income properties that produce cash flow and are poised to appreciate is a strategy that is looking better than ever. Today's uncertainty creates opportunity. And for buy and hold investors, this is a moment to lean in. While headlines swing the market, your rentals still collect rent. While traders try to time the Fed, you're locking in fixed rate financing and hedging against inflation. We've all watched the market drop over 10% in 2 days. It's absolutely brutal. But during that, my rentals didn't even flinch. They appreciated. They produced cash flow. They held steady while others panicked. That's why in times like this, I doubled down. So let's zoom out. The market is fluctuating wildly. Interest rate cuts are on the table. Recession fears are becoming more of a reality. The same reasons making everyone else uneasy are exactly why I'm planting my flag on rental real estate in 2025 and beyond. Because while the rest of the economy and stock market is swinging uncontrollably from headline to headline, rental properties give you something rare in times like this: predictability. But how? Let's talk about the ripple effect these Trump tariffs might have on real estate and why, believe it or not, that may be good news for long-term investors. With tariffs in place, the cost of building materials like steel and drywall is climbing fast. Builders were already dealing with a 34% spike in material prices since 2020. Now, with new tariffs layered on, experts estimate we're adding more than $9,000 to the cost of building a single-family home. The U.S. home building industry relies heavily on imports, especially from countries now facing steeper tariffs. Canada supplies nearly 3/4 of our softwood lumber. Mexico is where we get most of our drywall. And China, they supply everything from aluminum to appliances. These costs don't just stay on the builder's balance sheet. They get passed along to buyers and renters. Which brings us to a critical point. Higher construction costs means fewer new homes will get built. Many developers are hitting pause because the math on new development no longer pencils out. How are they supposed to know what prices might be in the near-term future? That shrinks supply. But what about buyer demand? That's still strong. Home buyers are still in the market looking for inventory. And when supply drops but demand doesn't, prices and rents go up. If you already own rental properties, or if you plan to, you're in a great position. Because while new development slows down, the properties you already own or are buying now just became even more valuable. Because real estate investments are more than just land and shelter. Think of a house as a bundle of raw materials. There's the wood, the concrete, copper, petroleum-based products, and the labor that it took to put it all together. Tariffs raise the cost of all of those inputs. So when you own the finished product, your rental property, you're essentially holding a portfolio of inflation-protected commodities that also generate income. That's the idea behind what we call packaged commodity investing. You're buying real assets, tangible goods that are difficult to replace, and renting them to tenants who cover your expenses while inflation pushes their value higher. And there's one more strategy I love, which is buying below replacement cost. Let me explain what I mean by this because I want you to understand this concept. Let's say it currently costs about $300 per square foot to build a home in your market. That includes the materials, labor, and permits, all the inputs that inflation is expected to make more expensive. But what if you can buy an existing home for $200 per square foot? You're able to lock in that property for less than it would cost to rebuild it today. That gives you a built-in safety net on your investment. And here's why that's so important today. As inflation continues pushing up the price of raw materials and labor, the cost to build new homes will only go higher. But what about existing homes? They still appreciate. So when you're able to buy below replacement costs, you're basically getting tomorrow's value at today's price, and inflation does the heavy lifting for you over time. It's like buying a portfolio of commodities that are rising in cost, all packaged together in a house. That's why in an environment like this, I'm always looking for deals where I can get in under replacement cost. Because when everything gets more expensive, the smart play is to own the assets that everyone else will be willing to pay more for later. Even better, you're not paying full price out of your own pocket. With real estate, you only need a down payment, which is a fraction of the purchase price, often only 5 to 25%, and the bank covers the rest. Then your tenants pay the mortgage, your costs stay fixed, and over time, rents and values rise. In other words, inflation works in your favor. Now, let's zoom out for a second. Construction is slowing. Builders are hesitant. Developers are pulling back. That means fewer new homes will be available in the future, and those that do come to market will be more expensive. And as for the rental market, there will be a tighter rental supply because there's just simply not enough new inventory coming online. This supply and demand imbalance is poised to push rental prices up in the future. If you're holding or buying rentals right now, that scarcity becomes your opportunity. You're positioned to benefit from rising rents, appreciating assets, and a shrinking pool of competition. This is how smart investors turn macro uncertainty into personal wealth-building opportunities. Because here's what I do know. Markets recover, sentiment shifts, inflation may cool. But the people who take action during uncertain times, they're the ones who come out ahead. While others stress about job security or watch their retirement accounts dip again, my rental assets are still collecting rent, still appreciating, and still building my net worth. And look, I'm not some market predicting genius. I just got started and took action, and I stayed with it. That's why I'm telling you, now is a great time to start. And if you're not sure where to begin, that's exactly what my Getting Started in Real Estate guide is for. The free strategies inside will walk you through how to wholesale and flip properties to build up the capital you need to buy your first rental property. First, let's break down how this actually works, how a small down payment can unlock a big asset that pays you month after month. Let's talk about leverage and why it's one of the biggest advantages investors have. When you buy a property, you don't pay full price. Instead, you use a mortgage. That's called leverage, and it's how everyday people are able to own high-value assets that grow in value over time without needing hundreds of thousands of dollars sitting in the bank. Let's say you buy a $350,000 rental property. Instead of paying cash, you put just 20% down. That's $70,000 out of pocket. Here's what happens over the next 5 years. Your tenant covers the mortgage, paying down the loan and building equity for you. The property appreciates at a conservative 5% annually, which means that your $350,000 home could be worth nearly $446,000 in 5 years. That's nearly $96,000 in equity just from appreciation, plus the monthly rent you've collected along the way. So let's break it down. You invested $70,000. 5 years later, you've made back more than that in appreciation alone, not even including the rent or the equity your tenant paid down. Now tell me, where else can you earn those kind of returns on a safe asset that you didn't even fully fund yourself? And here's where things get really interesting. You don't have to stop at one. Let's say you made $200,000 wholesaling or flipping houses. That's enough to put 20% down on 3 of those rental properties, giving you control of over $1 million in real estate assets. And again, you're not paying the mortgages, your tenants are. You're collecting rent from 3 properties, building equity in all of them, watching them appreciate, and getting depreciation benefits when tax season comes around. That's the power of leverage. That's how real estate compounds the longer you stay in the game. 1 rental becomes 2, 2 becomes 4, 4 turns into a portfolio that supports your lifestyle. That's why I'm doubling down on rentals in 2025. While the stock market feels unpredictable and inflation's still a threat, I'm holding assets that pay me every single month. I can scale faster, grow smarter, and build something that I know will last. Look, I'm not here to predict the market, and I don't have a crystal ball, but I am here to say this. Rental properties don't care about headlines. I've seen market crashes, inflation scares, interest rate spikes, even global turmoil. And through it all, my rentals appreciated. They kept cash flowing. They kept showing up month after month after month. When things feel uncertain, smart investors double down on what works. And right now, with inflation driving up construction costs and rate cuts potentially on the way, owning cash flowing rental property might be one of the smartest plays that you can make. You don't need to quit your job or wait until everything's perfect. You just need the right first step. That's why we created the Getting Started in Real Estate guide. It walks you through everything step by step. How to wholesale your first deal even if you've got no money or experience. How to scale into fix and flips for bigger returns. And how to use those profits to build a portfolio of cash flowing rentals. This is the recession-proof roadmap. The same one I used to build a portfolio worth over $10 million and generated over $400,000 in rental income last year. The same one thousands of others have followed to take control of their finances and build something real. And finally, let me ask you something. Do you think Trump and his entire family like real estate? Do they own a lot of it? Does he want real estate to do well? Do you think he'll do whatever it takes to make sure real estate thrives during his time in office? I think the answer is a resounding yes. So if you've been sitting on the fence, this is your moment. Click the link below, grab your free copy, and let's make 2025 the year you stop watching from the sidelines and start building wealth that works, even when the headlines would lead you to believe otherwise. That's it for today. Thanks for watching. If you got value from this, hit the like button, subscribe for more tips, and drop a comment if you have any questions. And don't forget to check out the free Getting Started guide link below. I'll see you in the next video.